Hey guys, it's Patrick. What happens when one of the world's largest financial institutions with over $600 billion in assets suddenly collapses? The bankruptcy of Lehman Brothers didn't just mark the downfall of a financial giant. It set off a chain reaction, leading to a global recession that cost millions of people their jobs, evaporated savings, and plunged the global economy into turmoil. But beyond the immediate chaos, what was the lasting fallout, and how can we learn from it to protect our investments? In today's video, we delve into the pivotal lessons from Lehman Brothers' collapse, an event that sent shockwaves through the entire economy. We'll uncover 3 actionable lessons from this event to protect your investments, understand how Lehman's downfall can transform into your most powerful tool in financial planning, and master the proven steps to safeguard your portfolio from crises by spotting the critical warning signs of future downturns. Armed with this knowledge, you'll be well equipped to navigate any financial landscape, ensuring the security and growth of your investments. Before we dive into safeguarding our investments, let's first address the implications of Lehman's collapse. It's crucial to understand the lessons history can teach us. More than just the failure of a financial giant, the fall of Lehman Brothers ignited a series of events that spiraled into a global financial crisis. On September 15, 2008, Lehman filed for bankruptcy. The Dow Jones plunged over 500 points, the largest single-day drop since the 9/11 attacks. After Lehman went bankrupt, it caused a lot of trouble in the financial world. One big problem was with AIG, an insurance giant. AIG lost a lot of money because it invested in mortgage-backed securities. Watch my previous video to see how those work. People got worried AIG might collapse, just like Lehman did. Around the same time, there was trouble with the Reserve Primary Fund, which is a type of money market fund. Now you might be wondering, what is a money market fund? Money market funds are like savings accounts, but with a twist. Unlike savings accounts, which are insured by the government to protect your money, money market funds carry a different type of risk because their value is tied to market performance. They invest in very safe, short-term financial instruments, such as government bonds or short-term corporate debt, aiming to offer higher returns than you typically get from just investing in a savings account. However, the Reserve Primary Fund encountered a big problem. It actually lost value due to investments that suddenly went bad, specifically those tied to Lehman Brothers. This is rare and alarming because these funds are designed to be safe and secure. They're where people often keep their cash thinking it's about as safe as a savings account. But when the Reserve Primary Fund broke the buck, meaning its value dropped below $1, suddenly what seemed like isolated troubles at Lehman Brothers had exposed vulnerabilities across the entire financial landscape, demonstrating how quickly confidence can vanish and systemic risk can spread, leading to rapid, widespread panic. The fear instigated by this event led to a domino effect, with investors rushing to pull their money from similar funds, severely limiting the liquidity of the financial system and worsening the crisis. To stop the situation from getting worse, the U.S. government, with U.S. Treasury Secretary Henry Paulson leading the charge, decided to step in with a massive plan. They set up a $700 billion program called the Troubled Asset Relief Program, or TARP for short. This program was designed to help the financial system by using government money to buy up the bad investments that were causing all the trouble, hoping to calm the markets and prevent other big financial institutions from failing like Lehman did. The crisis led to catastrophic consequences. The stock market had its worst week since the Great Depression, plummeting over 22%, wiping out trillions in wealth. Savings that people had worked their entire lives to build evaporated overnight, with retirement accounts losing significant value. Millions of jobs vanished as companies, squeezed by the credit crunch, slashed their workforces. The housing market was hit particularly hard, with over 3 million foreclosure filings reported in 2008 alone, leaving many families without homes. Beyond these numbers, these events marked personal tragedies for countless individuals, turning dreams of stability and security into nightmares of financial ruin. This crisis wasn't just a sequence of market downturns. It was a profound disruption that changed lives for the worse. So how can we shield our investments from such an event? Understanding the collapse of Lehman Brothers and its aftermath is not just about preventing loss. It's about empowering ourselves as investors. We see how quickly confidence can falter and markets can tumble. By recognizing early warning signs and adapting proper strategies, we can secure our investments against uncertainty. Let's draw a personal experience many of us can relate to: buying your first car. When I set out to get my first car, I had a clear budget and a list of features I wanted. I knew I wanted Bluetooth, a backup camera, and heated seats. Size was also a consideration. I wanted something bigger than a sedan, but not yet as bulky as a minivan. I researched model comparisons, read countless reviews, and sought advice from my family and friends who had first-hand experience with various cars and brands. After a couple weeks of research, I narrowed it to the last few options. I test drove them and ended up choosing a 2012 Dodge Journey. This car was an investment in my daily life. My hard work paid off in that research. I loved that car. This meticulous approach to buying a car mirrors how we should approach investing. Every investment carries a degree of risk, but thorough research and understanding can help mitigate that risk. When it comes to your hard-earned money, it's essential to look beyond the surface. With Lehman Brothers, for example, those who examine the company's heavy reliance on mortgage-backed securities, its dependence on real estate, and its high leverage ratio might have spotted warning signs. Investors who are invested in real estate may have been able to see the rising value of prices that were unrelated to GDP growth. Investing without a comprehensive understanding of the company's financial health and the market it operates in is akin to buying a car based on its color. Sure, it might look good and you can tell your friends, but will it get you to where you need to go without breaking down? To protect your money, you need to take care and think critically about what's the best place for it given your goals. But what should we look out for in specific? In preparing for this video, I kept seeing the same warning sign in every financial disaster. I first learned about the Great Depression in school. Back then, people were making money from the stock market going up in value, so they borrowed money to invest even more. People thought it couldn't go down. They became more irrational and borrowed even more. But this didn't end well. When prices crashed, it wiped out millions and caused the Great Depression. We saw something similar with the housing market crash that led to the 2008 financial crisis. People and banks borrowed more and more money, betting that housing prices would always go up, but of course, they didn't. This story shows us that borrowing too much money can be really dangerous, especially when you're betting on something risky. Leverage can be very useful, but too much leverage is dangerous. When you see people or companies starting to borrow a lot of money, especially on risky bets, that's when you should be cautious about putting your money there. Understanding how much a company is borrowing compared to others in its industry can give you a good idea of its risk. For example, in my previous video, we talked about how Lehman Brothers borrowed way more than other banks, which was a big red flag. You can check any public company's balance sheet on their Form 10-K. We did that in the last video. So if we spot warning signs, what should we do to protect ourselves? In the early 2000s, just before the financial crisis hit, there was a general belief that real estate prices could only go up. Many investors, both seasoned and novices, funneled as much money as they could into the real estate market, convinced that it was a fail-safe investment. Yet the harsh reality that unfolded told a different story. When the bubble burst, the impact was far-reaching, affecting not just the speculative investors, but also everyday people who believed their investments were bulletproof. Lehman's overexposure to real estate was a prime factor in its collapse. This cautionary tale serves as a stark reminder. Never assume an investment is entirely safe. Every investment carries inherent risks, and recognizing this fact is crucial for making informed decisions. Rather than putting all your eggs in one basket, diversification is key. Diversification involves spreading your investments across a variety of assets to mitigate risk. This strategy doesn't rely on the success of a single investment. Rather, it creates a net, allowing other investments to potentially offset any losses. Diversification can look different for anyone. You can mix up your investments with stocks, bonds, and maybe even some real estate. Or you might spread your money out across different business sectors or countries. A really straightforward way to diversify is by putting some of your money into index funds, like the S&P 500 Index Fund, VU, or the NASDAQ 100 Index Fund, QQQ. These funds track a broad market index, so you're essentially investing in a lot of companies at once without having to buy a share of each one. In addition, most trading platforms allow you to buy fractional shares of index funds, so you can diversify with as little as $10. Adding bonds to your mix can help smooth out the ups and downs of the stock market, and keeping some cash in your portfolio gives you flexibility and a safety net when the market gets rocky. The main idea is to spread your portfolio in a way that matches how much risk you're okay with, your financial goals, and how long you plan to invest. The downfall of Lehman Brothers and the subsequent global financial crisis underscored the critical importance of proper due diligence. caution with leverage, and diversification in investing. By fully appreciating the risk involved, conducting thorough research, and diversifying our investments intelligently, we can navigate the financial landscape with greater assurance and protect our wealth against the unpredictable nature of markets. Our goal should not only be to grow our wealth, but to preserve it through strategic planning and informed decision making. We've unpacked the 3 lessons from Lehman Brothers' downfall, but what will cause the next crash? Right now, there's a growing concern around private credit, a nearly $2 trillion industry. Could this be the next bubble? Watch my video on private credit and how it works to better understand these concepts. Thanks for watching. See you next time.